Hey traders, Desmond here. Welcome back to the IronFX podcast. Today we are talking about divergence and how you can trade it without turning into a signal chaser. Here's the thing. Divergence sounds technical, but it is really just a mismatch. Right? Price is saying one story and momentum is saying another story. And when you learn to read that mismatch properly, you start spotting moves that are running out of fuel or pullbacks that are about to end. Let me frame it with an image. Imagine two people carrying a heavy couch up a staircase. When both are pushing together, the couch moves cleanly. But if one person is still forcing it higher while the other is losing grip and slowing down, right, the couch starts wobbling. That wobble is divergence. Price is still moving, but the energy behind it is fading. Now, traders usually spot divergence using momentum indicators. The common ones are the Relative Strength Index, also called RS1. Another is MACD. Another is the stochastic oscillator, right? You do not need to obsess over which indicator is best. The concept stays the same. Price makes a new swing, but momentum does not confirm it. There are two main categories you should know: regular divergence and hidden divergence. Regular divergence is usually a reversal warning. Hidden divergence is usually a continuation clue. Let us start with regular divergence. Bearish regular divergence looks like this. Price makes a higher high, but your momentum indicator makes a lower high. Translation: price is climbing, but the push is getting weaker. Bullish regular divergence is the opposite. Price makes a lower low, but momentum makes a higher low. Translation: price is dropping, but the selling pressure is losing strength. Now here's the mistake that blows people up. Divergence is not a buy or sell button. It is a warning label. It does not say the market will reverse right now, right? It says the current move may be running out of steam. And the market can keep running out of steam for longer than you expect, especially in a strong trend. So if you short every bearish divergence in a powerful uptrend, you are basically stepping in front of a moving train and saying the engine sounds tired. That's not trading, that is gambling with extra steps. And this is why context matters. Divergence works best when three things line up. First, it shows up at a meaningful area like support or resistance. Second, the move looks extended, meaning multiple pushes in the same direction. Third, you get confirmation from price action or structure. Let me give you a practical example using gold. Imagine gold has been rallying and it reaches a clear resistance zone. Price prints a swing high near $2,050. Then it pulls back and pushes again and prints a slightly higher high near $2,055. But the relative strength index does not confirm it. On the first high, RS1 peaked around 75. On the second, it only reaches around 68. Right? But that is bearish regular divergence. Higher high in price, lower high in momentum. Do you short immediately? Not if you want to stay in this game long term. You wait for the trigger, and the cleanest trigger is structure. Here is a simple way to trade it. You spot divergence at resistance, then you wait for price to break a prior swing low on the 1 hour chart or the 4-hour chart, depending on your style. That break tells you the buyers are no longer in full control. After that, you can look for a pullback. If price retests the broken area and fails, that is often your entry. Your invalidation is straightforward. If you are taking a bearish divergence short, your stop goes above the most recent swing high that created the divergence. And your first target is the near support. If momentum really flips, you can trail or aim for the next level down, right? Now let us flip the script and talk about hidden divergence. Hidden divergence is what trend traders love because it often shows up during pullbacks right before the trend continues. Bullish hidden divergence happens in an uptrend. Price makes a higher low, which is good, but the momentum indicator makes a lower low. That sounds weird at first, but here's the meaning. Price held its structure even though momentum dipped harder during the pullback. Often, that is the market loading the spring again. Bearish hidden divergence is the same idea in a downtrend. Price makes a lower high, but momentum makes a higher high during the pullback. Translation: the pullback looked energetic on the indicator, but price could not actually reclaim structure. That is often a setup for continuation lower, right? So here's my hot take. Good traders do not pick a side and fall in love with it. They adapt. If the market is trending cleanly, hidden divergence can help you join the trend at better prices. Or if the market is stretched into a major level, regular divergence can warn you not to chase, and sometimes it can set up a reversal. Now we need to talk confirmation, because this is the difference between professional execution and retail guessing. There are three confirmations I like. 1. A break of structure. This is the most objective. The market actually takes out a key swing point. 2. Rejection at a level. Think long wicks, failed pushes, or a strong reversal candle that shows the level is defended. 3. A lower high after bearish divergence or a higher low after bullish divergence. In other words, the market starts building the new direction. Also, be careful with time frame. Divergence on the 5-minute chart can be pure noise if the 1-hour chart is pushing hard. A practical approach is this. Use a higher time frame for context, like the 1-hour chart or 4-hour chart, and then time entries on a lower time frame, like the 15-minute chart. Let us hit the common traps, because I have seen traders get caught by this over and over. Trap number 1. Trading divergence against a strong trend with zero confirmation. In strong trends, divergence can appear multiple times before price finally turns. Trap number 2. Forcing divergence on messy swings. If you have to squint to find the highs and lows, skip it. Trap number 3. Not defining invalidation. Every divergence trade needs a clean point where you admit you are wrong. If you do not define it, you will hold and hope. So here's a quick decision process you can run in your head before clicking anything. Is divergence forming at a meaningful level, like support or resistance? Has price made an extended move, like multiple pushes in one direction? Do you have confirmation, like structure breaking or clear rejection? Honest your risk to reward sensible, like 1 to 2 or better. If you cannot answer those quickly, do not trade it. Because the goal is not to trade more. The goal is to trade better. If you want to practice divergence without overtrading, do it like this, right? Pick one instrument like gold or euro-dollar. Pick one higher time frame for structure. Mark divergence only at obvious levels and screenshot 20 examples. You will start to see a pattern. Divergence by itself is a hint. Divergence plus structure is a setup. All right, let us wrap it up. Divergence is a mismatch between price and momentum. Regular divergence is often a reversal warning. Hidden divergence is often a continuation clue. But the real edge comes from context confirmation and disciplined risk management. If you enjoyed this episode, follow the IronFX podcast, and I will catch you in the next one.